Hey, what's up guys? John here. A lot of people yesterday said that interest rates should go much higher and that the economy can afford to increase interest rates to 9%, 10%, 12%, very similar to what we had in the 1980s. Now, I think that interest rates should be much higher. I think we should have a balanced economy. I think that we should really dial this back and pull this economy back to earth. However, I just want to really paint the picture of the true scope of where we stand as an economy and why we are walking off cliff's edge every quarter or a half a percentage point that we go forward. So take a look at this. I'm going to leave all of the notes, everything in the description below this video so you guys can all go through this and verify everything. If I have anything wrong here, as always, I'll gladly delete the video and I'll give you full credit for proving me wrong, because the goal here on this channel is to bring 100% fact to everything that I say. If I'm wrong, let me know, and I'm going to comb through the comments and I'll go through it all. So median family income in the 1980s was $21,020. And at the end of this, I'm going to share with you all the facts. 17 and all the sources. 21,020, right? Monthly income $1,756 per month. House cost $47,200, which is 2.25 years salary, right? So you work 2.25 years, you can pay off the house in full. Mortgage payment, 20% down, 1985 at 12.96% interest rate is $559 per month, right? So if you look at the 1756 monthly income as a median, it comes out to 3.14 times monthly income, right? So what now it looks like is the median family income is $67,521, which is $56.2675 per month, right? And so today, the housing cost, it would take 7.94 years to pay off. So you'd have to work almost 8 years and pay every single penny, 100% of all wages, straight into the house to pay it off, right? So it's much different. Before it was 2.25 years, now it's about 8 years, right? Mortgage cost, with a mortgage interest rate of 6%, right now it's higher, it's 6.5%, 7.5%, depending on your credit score. This just spiked a couple days ago. So now it's $2,200 a month, right? At a 6% on a 374.9 purchase with 20% down, right? That's 2.5 times monthly income. So it went from 3.14 times monthly income to 2.5 times monthly income. Car cost in 1985, per the data that I'm looking at, is $88.45. So it's about 5 months' wages, right? Well, today that Honda Accord is 4 months. 4.713 months wages, right? This is what they say. This is what they're saying that you can buy this Honda Accord for. I think the Honda Accord is much, much more expensive. We're seeing used car prices, 20, 30, 40% over. So if anyone can find a Honda Accord for $26,000, I would love to see that. Gas prices in 1985 was $1.12 per gallon, right? So on a 17-gallon tank for the Honda Accord, it would be about $19 to fill your tank. Today, that Honda Accord would cost $85. So it's 4 times more expensive, right? Whereas incomes went from $21,000 to $67,000. So it obviously gas prices and cost for ownership of vehicles has increased, as well as car insurance cost. And what we're also looking at is student loan debt in 1985, which is averages $5,200, right? So $5,200 is the median student loan debt in 1985, right? So it's 2.96 times month wages for a household, right? And back then it was between 9 and 10 million Americans went to college during the 1980s, and the population was about 237,900,000, right? So 237.9, and so roughly 4% of the population went to college back then. However, today the median college debt is $33,900. It's 6 months of family wages, whereas it went from 2.96 months family wages to 6 months family wages. And instead of it going from 4% of the population going to college, it's now 61% attend. So 61% attend. And then this does not factor in as well for our rapidly climbing credit card debt. So credit card debt right now is, you look at consumer debt. So back in the mid-1990s, it was here, or 1980s, it was here. And then you look, we're just going up a cliff, right? And so as we increase interest rates, what's going to happen? The cost of services, credit card debt's going to get more expensive. Everything is going to get much more expensive. Small businesses, they're going to have a harder time accessing credit, accessing money to grow and scale and stay alive, right, in this economy. So when people say, "Hey, John, we can afford interest rates," we just look at the facts. The facts are that our entire economy is built on 0% interest, right? And with that, we factor in higher prices for college, for education, for food, for gas, for everything. Everything is going up, up, up. So if right now we have this situation, whereas we left that period of 10, 12, 15, 18% interest rates where things are still relatively affordable in relation to income, what do we have now? We have a huge problem, right? And so as we increase interest rates, we're just going to push more and more people into bankruptcy, more and more people out of home ownership, more and more people into poverty. What generally happens in times of financial despair? Families break up. It's very bad, right? And so this is the data. So again, $21,200 is the median income in America, 1980, right? Median family income today, $67,521. The median home price, $47,200. Median home price today, $374,900, right? So it comes out to about 8 years worth of wages, right? And here, the Honda Accord was $88,450, as I mentioned, and today it's saying about $24,000. Everything was everything was different. So even going to movies back then was $3.55. They say you can go to a movie today for $9. You go to a movie today with 3 people, it's $50, $60. I don't know where they're getting these numbers. So $26,500 is what they're saying that you can get this car for today. The average interest rate, as I went through in this chart here, 12.96, right? 12.96%. So $559 is the payment on a $47,200 purchase price with 20% down. Good luck for most people to come up and put $74,900 cash down. They don't. A lot of people are putting, 3.5%, 5%, 10% down, and then taking out mortgage insurance and throwing that on top of their mortgage. People can't afford these properties today, not at the same capacity they could in the 1980s. Same thing, gas prices, $1.12, right? And we look at also healthcare. Health insurance is twice what it cost in the 1980s, twice what it cost in the 1980s. And everything is just much, much more expensive. So when you look at the data, you look at the facts, you look at the actual household credit card debt, it's a completely different animal. So when people think that, hey, John, I'm going to be able to, substantiate and just absorb a 1 or 2 or 3% increase in interest rates, I got another thing coming. Because these people, you look at it this way, when people qualify for a 30-year fixed rate mortgage to buy a house today, generally it's about 26%, 25 to 27% of monthly gross income should go to housing costs, right? Now, what's happening here? It's no longer that scenario. Right now, it's 3.1, it's 2.55 monthly income, right? So people are so house poor today. As they continue increasing interest rates and people that are on adjustable rate mortgages, what's going to happen? Eventually, when these people need to access liquidity, either to do a cash out refinance or to potentially sell the property, what are they going to do? They're going to have to sell the property to another buyer who is probably worse off than they are. So we're stepping into a whole different dynamic in the economy. This is not a scenario in which, hey, we'll throw an 8% or 9% or 10% interest rate out there and balance out the economy easily. No, it's going to be a train wreck. Like we're entering what I would like to call a depression, essentially. Like as we start pushing all this debt from a 0% interest rate economy until we're going 8, 9, 10% interest. It's going to get bad out there. That's why I'm saying everyone needs to really come up with a strong game plan, just in general. I'm just like, I heard a saying a long time ago, I've said it before, that smart people see things for how they are and everyone else sees things for how they want them to be. How things really are is that Americans are strapped to their necks in debt. And as they increase these interest rates, it's going to get harder and harder. So what do? You need to make more money. Everyone needs to make more money, including myself. Everybody needs to make more money to take into consideration of how expensive things are going to be in the next year, 2 years, 5 years. Like looking at even the idea of looking at something like, I make, let's throw a random number out, $100,000 a year. 2 years ago, $100,000 a year, $8,000 a month, you could live well, right? You could go get a nice apartment. You could spend $1,500 a month, get a really nice place. That same apartment today, 2 years ago, probably $3,000, right? Food costs went up, gas prices went up, everything is going up. So that $100,000 purchasing or $100,000 you were making a couple years ago, the purchasing power today is probably closer to $70,000, right? And so if we're continuing down this trend, what's ultimately going to happen is that maybe next year that $100,000 has the purchasing power of 50, right? So then looking at 2, 3, 4, 5 years from now, what does a $100,000 purchasing power have? Almost nothing, right? And so we look at this, we have to take into consideration, hey, if I'm making X today and we're heading in this direction, that would mean that I would probably need to make 2X or 3X my income to be able to offset all these upcoming problems, right? And that's what I think is really important right now. People just pay attention to the data, pay attention to all this information, and come up with a really, really good plan that's going to be able to substantiate and provide enough value, monetary value, to yourself and your family. And my whole motto is, if you can, the more people that can benefit from you being alive, the more money you're going to ultimately find a way to make, right? So if you provide a lot of value and really take care of your customers, take care of people, and scale it out in a cost-effective way, then I think you're going to do really, really well. But think about this. This debt level is not sustainable. We're stepping into a really, really big debt bubble. We're stepping into a huge problem, and things are only going to get worse. So that's my. I'm going to leave everything pinned in the description notes below. You guys can feel free to verify this information. If you have any challenges to this, drop it in the comment section. If you can correct me on anything, I'll give you full credit, and I'll pin you at the top comment for giving the better information or supplying more value in something maybe that I missed. Subscribe here. Also subscribe to my second YouTube channel. It's going to be a call-in interactive show this upcoming week. And if you want to get started on YouTube, you want to make money online, you want to invest in real estate when things hit the fan, need help with your credit, cashnow.video. That's cashnow.video. And catch you guys in the next one.